I had a question about like valuing a biotech or healthcare. Should I ask you now?
Too close to us. Okay, folks. I thought I'd start today's class by pulling up about, I think 93 of you have entered your Tesla numbers. Remember the valuation of the week that I sent out last week? I was hoping for like 350, but that might have been hoping for too many. But 93 of you turned it in. So I thought it'd be nice to pull up the crowd valuation to see what you found. This is what the distribution looks like. It's kind of peaks at 120 to 140, which must be pure coincidence that my starting number was what, 130? Just a thought experiment. If my starting valuation had been 180, do you think the entire distribution might have turned? That's what it is, right? Stock prices at 200. If you did your valuation today, could it be higher? Absolutely. The stock price, I mean, the notion that you can somehow be objective, I wanted to set it aside. Please be honest with yourself. Things affect you, and that can, that can show up in your valuation. So that was just, I just wanted to show you that. And now, if you get a chance, try it with the Adani Group. You're saying, I don't know Indian company. I don't either. Okay. But I know infrastructure companies, and infrastructure companies are big capital intensive companies with low margins. You say, I've never valued a family group company. Well, no, so what? Still cash flows, growth, and risk. So give it your best shot, see what you get. And next week, I'll show you the distribution for that, and we'll see how that plays out. So let me shut this down and go to the start of the class test for today. Today, we're going to talk about something called an implied equity risk premium. Remember last class, we talked about historical risk premiums, and I looked backwards. And then I really dug a grave and buried it. I said, it's backward looking, it's noisy, and that's survivor bias, right? See, why are we still using it? I don't. But that's the way most people still get historic risk premiums. Today, I'm going to give you an alternative. It's going to look complex, but I'm going to simplify it in the start of the class test. So you're going to be my guinea pig today, right? Don't worry, this is not a complicated, so don't worry, don't overthink it, right? So let's assume that you're looking at an investment where you have a guaranteed cash flow of $1 every year forever. And I came to you that investment. How much would you pay for that investment today? You're going to get $1 every year in perpetuity, right? So you'd pay just $1 for just $1, you get it back in 1 year, but then everything else is pure icing on the cake, right? If you told me $1, I probably wouldn't sell you the investment, right? In fact, I'll probably give you the trigger at which I'd sell it to you. So you want to stick with the dollar, or you want to try another number? $5. If you take $5, what are you requiring as a rate of return? You're going to get $1 every year. Remember, the principal doesn't come back. You paid $5. You're going to make 20%. So you're telling me you want a risk-free investment of 20, that will deliver 20%. Okay. That's effect. I'm not saying don't rethink it, but that's what your price tells me, right? How much did you pay? $25. Yeah. You see basically that's going to be my trigger, right? So if you offered me $25, I'm probably going to say that's close to. So the risk-free rate I can get by what you pay for risk-free investment. Let's make this trickier. So, the risk-free investment is there. I can tell what a reasonable return is. If it's 4%, $25. Let's suppose I came to you with the same kind of bet, but now I'm going to give you $1, but it's going to come from an average risk business. This is an expected cash flow. So this as the average risk equity. You're going to get a $1 each year forever. So let me stay with you. You offer $25 for that risk-free. Will you offer less or more for the second bet? So give me a number. $10. He said $10. If you offer $10, what's your expected return on equities? 10%. So what's the equity risk premium that I get out of that? 4% was the risk-free rate. You wanted 10%. You're telling me your equity risk premium is 6%, right? Do you see where I'm going to go with this, right? You ask people, what do you like to make? They're going to say, I'd like to make 8%, 9%. But what you pay is the best indicator of what your expected return is. So if you pay a lot for a risky investment, don't tell me that you want a high equity risk premium. You've priced the investment to earn a low equity risk premium. An implied equity risk premium, that's all I'm going to do is I'm going to look at what you pay, not what you say. I'm going to use the level of stock prices to back out the expected equity risk premium. So it's not rocket science. It's just the mechanics of, I don't trust people when they tell me this is what I'd like to make, but I can see what they pay and I'm going to back out of that what the equity risk premium should be. So let's build on this, right? So you wanted a 10% risk premium. I'm sorry, 6% or roughly 6% equity risk premium. Studies consistently show that risk aversion is not something you get to pick. It's what you're born with, and it depends on how old you are, whether you have a family. So, the degree of risk aversion varies even across this room. I tell people I have 4 kids. I could have told you when they were 4 years old whether they were going to be option traders or hold bonds. My oldest, until he was 15, still came down the stairs, holding onto the banister. Fixed income guy, if you ever saw one, right? I might fall now, but right now. My youngest, when he was 2 years old, took off from the top step, expecting to be caught before he hit the bottom. There's an option trader. Risk aversion, some of it, you're just born with. Some of us are more risk averse than others. So Match.com probably should have a risk aversion section, right? Now, what's your risk aversion coefficient? But risk aversion does also change over time. Studies consistently show that as people age, they get more risk averse. For lots of different reasons. So now I'm going to connect it to equity risk premiums. You take markets like Japan, parts of Europe, they're aging, right? Even China is, because you've reached a point where because of an intermediate period of one-child policies, you've now reached, the population's going to age. It's neither good nor bad. But if you just take aging into effect, what's going to happen to equity risk premiums in these markets? The risk premiums are going to go up, right? Because as you get older, you get more risk aversion. The market's getting older, you're going to see the risk. So you can see that risk aversion can change because of demographics. So risk aversion can be different because you're born with different. Risk aversion can change because of demographics. Let's complete the process. Let's suppose while you're sitting here today, don't freak out, nothing bad's happened. But let's say that you get this big crisis. It could be COVID hitting. Remember, it happened over a couple of weeks. It could be, some news that makes you think there's a recession coming. 9/11. Do you think your risk aversion might be affected, that you were willing to pay $10 for that dollar? Maybe would that change if you got it? It makes it's common sense to say, I was willing to pay $10 before this crisis, but now, you know what? I'm going to pay only $8. So let's see where we are. Equity risk premiums can vary across people. It can vary because of demographics, and it can vary across time. I'm making an argument that whatever approach we use to estimate equity risk premiums needs to be dynamic. It needs to be dynamic because you can't have a number that stays the same as we're going through crises and good times and in bad times. It doesn't work that way. Historical risk premiums have zero chance of doing that, right? Why? Because you have 99 years of history dragging you towards the same number. You can be in the worst crisis of all time, but you're looking back and everything's okay. So I'm going to make arguments for implied equity risk premiums, and I'm going to tell you why I haven't used a historical equity risk premium in 25 years to value a company. I've laid the foundations for it, but I need to replace it with something else. And I'm going to give you my approach to estimating implied equity risk premiums. I don't expect 100% buy-in, but I want you to think about why I'm doing it. And if you don't like it, what your middle ground is going to be, because you can pick a different approach, but it's got to be dynamic. It's got to be forward-looking, and you got to come up with numbers that reflect the times you're in. So let's turn back to, I think, page 64 was where we were in the notes. Okay. And let's talk about implied equity risk premiums. So the basic idea is what I just showed you. If I have expected cash flows, what you pay for something should give me a sense of what you expect to make. In fact, there's a market, but this is how we get expected returns. It's a bond market. Somebody remind me again what the yield to maturity on a bond is. How do you compute the yield to maturity in a bond? You want to try? How do you get the yield to maturity in a bond? You're jumping ahead. Before even getting there, what do I start with? I start with the price you paid for the bond. Then I get the coupons every year. And then I look at the face value, and the yield to maturity actually doesn't take into account reinvestment. It just says, what discount rate makes the present value of my coupons and face value? Implicit, there are assumptions about reinvestment, but the yield to maturity is like an IRR, right? It's an IRR for a bond, price of the bond, coupons and cash flow. It's a forward-looking number. Is it dynamic? God, was it dynamic last year? Remember how much the interest rate changed because the price of the bond was changing. I'm going to take what we do in the bond market and try to do it with stocks. Let's do the easy part. Can I get the price you're paying for stocks? Yeah, the S&P 500 index. But rather than coupons, what do you hope and pray you will get when you buy stocks? Maybe dividends. In the US, increasingly buybacks. And unlike a coupon, which is a fixed number, I don't know what this will be. I can tell you what it was in the last 12 months leading in. I might even be able to get estimates of what people are expecting earnings and cash flows to grow. So it's a little messier than a bond, but still the same problem, right? You got the price, you got the cash flows. And just as I compute a discount rate that makes the present value of the bond cash flows equal to the price of the bond, I can compute a discount rate that makes the present value of cash flows on equities equal to what you paid up front. So this isn't rocket science. It's just taking something from the bond market and applying it to stocks. So let me take you back to the start of 2020. Different world we lived in, right? Nobody wore a mask. Maybe in Asia, if they wore from SARS or whatever else. But if you were masked, probably people thought you're probably trying to rip them off, and they called the police on you. This was pre-COVID. This was the implied equity risk premium at the start of 2020. So here's how I got it. I got the level of the index, 3,230.78. So instead of buying a bond, you bought the 500 largest market cap stocks in the US. I know what you paid for it. I told you, I can't tell you what the cash flows will be in the future, but I can tell you what the dividends and buybacks were in the 12 months leading into the start of 2020. And dividends and buybacks were 150.50. None of this is difficult to get. They're all public information. You can go to the S&P website, look up dividends, look up buybacks. So I know what you paid. I know what the cash flows were last year. Let me bring in one final piece of the puzzle. The S&P 500 is the most tracked and followed index in the world. There are at least a dozen analysts who track just the index. They don't even do individual companies. They track the index, they forecast earnings. Are they always right? No, nobody's ever always right, but that's their focus. And at the start of 2020, they were expecting a growth rate of about 4% a year in earnings and cash flows. Do you see where I'm going to go next, right? I take the 150.5, I grow it at 4% a year to get expected cash flows. Why do I stop after 5 years? Because I'm getting increasingly uncomfortable. These are the 500 largest market cap companies in the US. They can't keep growing faster than the economy for the long term, because where's the growth going to come from? So at the end of the 5th year, I put these companies collectively into stable growth. Remember, we talked about that as a closure. And what's a stable growth rate? A growth rate at which the economy can grow at over time. And I use the risk-free rate as my proxy for the growth rate. You're going to see me do this repeatedly because I'm going to say that's the best estimate. That was 1.92%. So think of this as a present value problem. I know what you paid. There are my cash flows. Beyond the 5th year, this is the present value of all cash flows beyond year 5. That's a terminal value equation, just written as an equation. I solve for R. You say, how the hell am I going to solve that? Mathematically, it's really messy, right? Thank God for the solver function in Excel, or the goal-seek function. All you do in that function is you set the value equal to the level of the index and solve for R. And 2 seconds later, Excel comes back and says 7.12%. You're saying, what does that even mean? If you bought stocks at the start of 2020, I don't care what you hoped you would make, what you prayed you would make, what you thought you would make, given what you paid for stocks, you can expect to make 7.12% a year. The risk-free rate, T-bond rate, was 1.92%. The difference is an implied equity risk premium. You see why I call it implied? I'm backing it out from what you paid. You don't like it? You paid for it. You think it's too low? Then stop buying stocks. I am not forcing you to do it. There's no model behind it. It's completely model agnostic, right? It just says, this is what you paid. These are your cash flows. This is what your expected return should be. Do you think that number would be different on January 2nd of 2020 and January 3rd? What, of all the inputs that I've used, which is going to be the one that's most volatile? Every day when you open up the paper and you look at movements the previous day of all of the numbers, earnings, cash flows, S&P 500, you're giving away the answer there. It's going to be every time the index moves, your expected return is changing, right? In fact, it's because your expected return is changing that you're moving the index. You know why I picked the start of 2020? Because 6 weeks later, COVID hit. February 14th, I think, was the official day when the Italians announced they were, because until then we thought it was on China and cruise ships and it'll never come aboard here. You know? It's amazing how much in denial you were. And February 14th, we heard that there are a couple of hundred Italians who'd never been to China or on a cruise ship and they had COVID. It's almost like people come, oh my God, it's here. And here's what happened to the implied equity risk premium. See, this is where we are up till February. So it's almost till February 20th or 21st. You could say, oh, nothing's happening, nothing's happening, nothing's happening. Oh my God, something's happening. And you could see the risk premium shoot through the roof. This is the US, the S&P 500, supposedly a developed market. This is not supposed to happen, right? In the course of 6 weeks, the equity risk premium went from about 4% or 4.7, 4.5 or 4.6%, almost to 8%. Are you surprised? I mean, you guys lived through those 6 weeks, but imagine we had no idea what was coming. The economy was shutting down. This could have been a depression. It could wipe out half the population. Nobody knew what was coming. Of course, risk premiums are going to reflect that. March 23rd of 2020 was the absolute bottom for that crisis. I actually saved newspaper articles from that day because they basically said the end is here. I got more calls from people I hadn't heard from in the previous 2 weeks. Said, what do I do now? Sell everything, move into a cave? I said, do whatever you want. Maybe take all your money, put in a brown paper bag, send it to me, and then go live in a cave, right? I'll use some money somewhere. But people were completely and totally panicked. One of the things I did during the COVID crisis is every week I wrote a post about what I was feeling then. Not that people cared about my feeling, but I wanted to record in real time. Because after the crisis passed, it's amazing how, with the benefit of hindsight, I knew everything was going to be okay. Really? I didn't. And I mean, if you want to see what happened on March 23rd, something broke the crisis. And it was one of the most amazing returns back to normalcy I've ever seen, because by September, the equity risk premium was back to where it was at the start of the year. I mean, this isn't the only time it's happened. You know, you go back to 2008. Every time we're in a crisis, I start to do the implied equity risk premium by day. I do it because it's cathartic for me, because otherwise you're listening to people tell you to freak out. I stopped watching CNBC. I stopped reading the news because nothing good is going to come out of that, right? But I compute the implied premium every day because it keeps me sane. It forces me to think about what's happening, how much are people demanding for risk, does this make sense? And there are periods where equity risk premiums can change dramatically. On a day to, forget about month to month, on an hour to hour basis, the equity risk premium can change. And if you're valuing companies, you need to keep tabs on what that equity risk premium looks like right now, because you're valuing a company on February 12th of 2020. It doesn't matter what the equity risk premiums will look like in the future. You are valuing a company in the market you're in, and you got to build in the premium that reflects it. Somebody back there had a question. Go ahead. Not at all, right? Those were your actual cash flows. So if you feel that they're too high, what do? You put a negative growth rate, right? You control the expected cash flows. This is not the only reason we use expected cash flows. They're sticky. You know what I mean by sticky? Dividends move remarkably little from year to year. The buybacks do go up and down, but cash flows are the least volatile number in this entire analysis. It's the S&P 500, and no crisis that I know of has ever been triggered by cash flows changing overnight. It's always been triggered by equity risk premiums changing overnight, people getting worried about the future. So you're right, I'm estimating cash flows, and I could be wrong, right? And it'll show up as what? A standard error around my implied equity risk premium. So I compute that. In fact, if you go to and I'll send you the spreadsheet after today's email of my February 2023 update, because I update this at the start of every month. And if you look at the range I get with my implied premium, because I allow for the fact that the cash flows could be too high, I replace with a 10-year average. I look at normalized numbers. My implied equity risk premiums range from 4.5% to I think 6.3%. You think that's a big range. Remember what the range was when I used historical risk premiums? 1 to 9. I'm not saying this is precise, but I'm saying that it's less imprecise than anything else you're going to face. No matter which approach you're going to have to make estimates. And here I'm willing to live with that range. It's a narrower range because there are fewer things I can go wrong on. Any other questions? Yes. Like the VIX? It's a contemporaneous variable, right? In other words, so let's say I gave you the VIX, which you can measure it on a daily basis. How do you convert that into a percentage premium? And you'd have to figure a triggering mechanism. But the VIX reflects exactly the same fears as what's driving your equity risk premium. The equity risk premium is more directly an answer to your question of, and also the VIX doesn't measure what you're actually paying for stocks. It's kind of an indirect measure where the VIX can do sometimes strange things as stocks are moving. This is a much more direct measure. It's very closely connected to intrinsic value. It says, tell me what you paid, tell me what you get, I'll tell you what you make as an expected return. So I said I used to do this at the start of every year. And when people ask, why aren't you updating? My reaction was, how much can it change in a year? And then came 2008. And I learned how much it can change in a year. So starting in September of 2008, I've been reporting this number on a monthly basis on my website. It's the very front page. I said, this is what it's the start of the month. And you see, you can get the monthly ERP going back every month to September 2008. You know how I use that premium? Start of February 2023. That premium is 5.41%. Every company I choose to value in February, I'm going to value with that as my premium. Why? Because I've got to live in the market I'm in. I'm valuing a company given where the market is today. What will I use next month? I have no idea. I'll have to redo it in March. It basically means that my valuations will constantly update to reflect what the market is demanding as a price for risk at that point in time. Will it make your intrinsic valuations more volatile? Yes. But it'll make it more realistic? Yes. Stable is not realistic in a world where everything is shifting around you. So let me bring you up to January 2023. Start of this year, the index was at 3839.50. You can drop the last two decimals if you want. The cash flows coming in, 181.99. So in the last 3 years, cash flows have gone from 150.5 to 181.99. Analysts are projecting a bad 2023, or at least a subdued 2023, but a bounce back in 2024. You think, but aren't analysts going to be wrong? It could be. But remember what I'm trying to estimate, given what people are expecting on cash flows, what is the internal rate of return? So even if they're being unrealistic about those expectations, I need to build them in. And doing exactly what I did in 2020, the return I got as my expected return was 9.82%. Do you remember what it was at the start of 2020? I'll take you back to that page. I think it was 7.12%, 9.82%. You know what it was at the start of 2022? 5.75%. The biggest one-year change in expected return on stocks that I've tracked. I've tracked this from 1960 to 2022. It's the biggest one-year change in expected return because you got a double whammy last year. T-bond rates went up and equity risk premiums went up as well. In 2008, equity risk premiums went up, but because it was a crisis, T-bond rates went down. You almost always get that offsetting. In 2022, both numbers pushed up. But at the start of 2022, the equity risk premium was 5.94%. That number has dropped at the start of February to 5.41%. Why? Notice the mood is somehow lightened in markets. You watch CNBC, people are smiling, they're laughing. It won't last that long. Enjoy it. Yeah. But clearly, the last 6 weeks, people seem to have got this new window. We've got this thing under control. Yep. Every week, usually. But they don't do it very. I'll tell you what the weakness with the analyst forecast. It's sticky. It seems to take a while for them. It's not that they don't update it often enough, but their updates are not as big as they should be in periods. So that earnings number has gone down about 6% over the last year as stock has gone from there's no recession to recession. It's almost like the analyst saying, what recession? So there is that stickiness in earnings. And here's what it'll mean. If analysts are overestimating the growth rate, what will it do to my equity risk premium? It'll make my equity risk premium be higher. That's the standard error issue, right? So if you took lower estimates of growth, you'll come up with 5.6% as your equity risk premium. And I accept that. There is going to be that noise in the estimate, especially in periods where earnings judgments are changing. To give you a sense of where this number falls in a historical context, here's what I'm going to do. I'm going to go back and show you what the implied equity risk premium has been through history. I would argue that every statement you hear about stocks is really a statement about equity risk premiums. You know what I mean by that, right? Stocks are overvalued, stocks are undervalued. I can restate it as a statement about equity risk premiums. So when you tell me stocks are overvalued, what are you telling me about equity risk premiums? That they're too low or too high? Too low, and you want them to be higher. So basically you're saying, hey, equity risk premiums become too low. When you tell me stocks are undervalued, you're making a statement of, so when I show you the equity risk premium at the start of 2023, there's all this talk about, is there pain coming? Will stocks drop? This is not going to give you a conclusive answer to this. But the question you're asking is 5.94% a low number? Is it a high number? Where are we? So to give you that perspective, here's what I did. I went back and got the equity risk premiums every year from 1960 through 2022. And it tells you the story of US equities for the last 60 years. Here are the 1960s. incredibly stable period for equity risk premiums, 3 to 3.5%. The US was the center of the global economic universe, and the premiums reflect that stability. 1970s, something is going on, right? What's happening to the equity risk premium? It's shooting through the roof. And what was the trigger? What did you say? Oil embargo, you mean? That was the, but remember, the oil embargo by itself was what started the ball rolling, but what did it create in the following years? Inflation. That was the first decade in a long time that Americans actually saw double-digit inflation. Why does higher inflation push up equity risk premiums? But that's a level, right? Risk is about uncertainty. So you got, anytime you asked about risk, it's got to be a story about a higher number must go with more volatility, right? And I think that's the problem. It's not the high inflation per se, but when you have high inflation, whether you like it or not, it comes with more uncertainty about inflation. I tell people, I give them a choice of two economies. One has 5% inflation, the other is 3% inflation. And so which one would you prefer to invest and do business in? Most of them say, I'll take the 3%. And I say, let me add to those facts. Let's suppose in the first economy, not only is inflation 5%, it'll be guaranteed to be 5% every year forever. And in the second economy, inflation is 3%, but it could be 1 or 5. I'll take the first economy over the second one, because inflation then becomes a constant. You know exactly how much of a wage increase you should demand, how much to raise prices. But high inflation goes with uncertainty about inflation. And through market history, higher inflation has gone with more risk premiums, higher risk premiums. Now, do you see why 2022 was unusual, right? Inflation went up, that pushed up interest rates. But because it was inflation triggered, not COVID triggered or banking crisis triggered, equity risk premiums also went up. 1978, the equity risk premium in the US hit 6.5%. You know what the Dow was trading at in 1978? 800. There were 3 numbers in the Dow. Can you imagine that? 3 numbers. What is it at now? 20-something thousand? In fact, Business Week ran a headline, stocks are dead, which should be a sign that anytime business magazines put a headline like that, it's time to buy. Because if you bought stocks in 1978, you rode one of the great bull markets of all time. Because as markets rose, guess what happened to equity risk premiums? So through the late 70s, the 80s, into the 90s, and then it keeps going. And it keeps going down. And in fact, at the end of 1999, equity risk premiums in the US hit 2%. Forget about the abstraction. If I said, if you invest in stocks, you'll make 2% more than the T-bond rate. And I said, would that be enough for you? Most of it said, no, that's not enough. That's a lot of risk I'm taking. 2% sounds too low. But guess what? People in 99 were saying, no, it's okay. Now, the stories were, there will never be a recession again. We've discovered the secret to everlasting growth with .com at the end. The moment didn't last that long because in the 2 years after, you had the .com bust, implied equity risk premiums bounced back to 4%. They settled in for a period between 4 to 5%. Nice stable period again. This is the thing about markets. They lull you into a sense of false complacency before hitting you around the face. So 2008, you asked me, market, we've been around 4%. I might even have said that. It's all in a recording somewhere probably. Oh, the use of 4% premium doesn't change that much over time. And markets are waiting just for that moment. Say, really? Let me show you. And there's 2008. Take a look at what happened. Premium shoots up. That is what crises do. They make and that crises not only made premiums go up, they stayed high for about 4 years. And in fact, since 2008, equity risk premiums have been both higher and more volatile than they were pre-2008. And I don't think that's going to change. You know why? Welcome to globalization. What does globalization do? It links us all at the hip. In 1988, if there was a crisis in Sao Paulo, you know what happened to US stocks? So where's Sao Paulo? Somewhere in Latin America. It doesn't bother us. China, that's Asia somewhere. Who cares? Today, if there's a crisis anywhere, it's a crisis everywhere, right? What does that do? It connects equities at the hip. There are benefits to globalization, but one of the downsides is around the world, equity risk premiums have become higher and more volatile. So if you look at that graph and you say it's 5.94%, that's where we are at the start of where does it fall? Well, it looks pretty good, right? For stocks, because you're earning a higher premium. This is not 1999. So if you're one of these, perpetual, the sky is falling, the world is ending, sell everything people, they've been saying that for 10 years now. They might have a good reason. Michael Burry might have a good reason for saying sell everything, but I don't see it backed up in the equity risk premium. So in fact, first week of 2023, somebody asked me, what do you think about stocks? They've had a terrible year. I said, they've had a terrible year. That's true. I mean, who can contest it? It's a fact. But given what equity risk premiums are right now, I feel okay. I mean, it doesn't mean there will not be a recession, won't affect my earnings and cash flows, but it's become the one number that I watch on a monthly basis. Because the alternatives are things like PE ratios, right? You can watch them, but they're all over the place. They don't factor in that interest rates are changing. This is like a composite number that brings in what happens to interest rates through the analysis, brings in what's happening in the economy through the growth rate, and then comes up with a composite number. Say, are you okay with this? At the start of last year, yeah, go ahead. That's about the economy, right? Less about the market and more about the economy, right? That's an earnings growth story. Because right now, if you're bearish about markets, remember I've used that 6% growth, the drop in 2023 bounce, but that's a soft landing for earnings. So even if there's a recession, we're assuming it's going to be a one-year effect. It's not going to leave lasting damage. But let's say you believe that this is the mother of all recessions coming. You know what's going to change, right? Your growth rate is not going to be plus 6% going forward. It might be minus 25%. 2009 was a mother of all recessions effect on earnings. That takes a long time to climb out of. So one way to bring in discussions or questions about the real economy is through the cash flows, build it in, then ask yourself, what kind of return will I make if I build in those cash flows? It's not going to be 5.94%. But if it's 4.94%, you're still okay, right? But if it's 2.94%, you say, maybe I should be selling stock. So whatever the story is, bring it in through one of the conduits you have. It's got to be cash flows, it's got to be growth, and then work out what the implied equity risk premium is with that, because otherwise it becomes a one hand on the other hand, right? I'm going to say something about market strategies and forecasts that I find, at least they irritate me. I'd rather be transparently wrong than opaquely right. You know what by opaquely right? You listen to this guy on CNBC say the stock could be 100, but it could be 30, but it could be 50, if this happens, it could be 120. And then at the end, he said, what did he ask me to do? Did he ask me to buy the stock or sell the stock? That's being opaquely right, because you're going to be right no matter what happens, because somewhere in the conversation, you threw in a number. Here, if I'm wrong, you can go back and say, you got the cash flow wrong. The advantage of implied equity risk premiums is you can't do the one hand on the other hand and dance away from the problem. You're forced to think about, what am I most worried about? Where will it show up? So if inflation is your concern, think about where it shows up in those numbers. If inflation continues to go up, what's going to happen? T-bond rates are going to continue to rise. Your equity risk premium will get higher because you need higher risk premiums. Every concern becomes a question you can ask about implied equity risk premiums. At the start of last year, the implied equity risk premium was 4.24%. By itself, that's not a troubling number, right? 4.24%. It's a little lower than what you'd have earned in the last 20 years, but it's a little higher actually than the 60-year average. You know what was troublesome though about last year's number? It was on top of a T-bond rate, which is 1.51%. 1.51 plus 4.24% gives me an expected return of 5.75%. So if you think about the total expected return you were making at the start of last year, you know what the only justification was? What choice do I have? Risk-free rates are too low. And in a sense, 2022 pointed out that there's a danger when you invest based on what choice do I have, because risk-free rates adjusted, equity risk premiums went up. So there's advantage to tracking both the equity risk premium and the total expected return. On both dimensions, the start of 2023 looks a lot better than the start of 2022. Even though people felt better at the start of 2022, right? Because they were coming off a bullish year. So sometimes how people feel is actually a contrarian indicator of how they should be feeling. Because you come off a good time, you pushed up prices, you pushed down risk premiums, you're actually in a more dangerous place than when you come off a year when you push down stock prices and pushed up expected returns and equity risk premiums. So the equity risk premium is the price of risk in the equity market. You can see it changing over time. Is there an analogous price in the bond market? Yeah, it's called a default spread on a bond. You know what I have in this graph? The red line is the equity risk premium. The black line is the default spread on a BAA rated bond. A BAA rated bond is an investment grade bond. It's actually one of the safer bonds. So basically, it's not AAA rated, but BAA rated. Notice the BAA rated spread. So that's a spread over the T-bond rate. So it's a price of risk in the bond market. That number also goes up and down. What causes it to go up and down? In good times, you stop worrying about default risk, you charge lower spreads. In bad times, you start more. And most of the time, the two move together, right? Price of risk goes up in the equity market, default spreads go up. 2022, equity risk premiums went up, default spreads also went up. Why? Because people were scared about inflation. But there are times when the two markets have diverged in the last 25 years. And when that happens, something strange is going on, right? Why are people getting more worried in equity markets and less worried in bond markets? I'll take you back to two of those times. The first occurred after 9/11. And Alan Greenspan said, I will not let the US economy go into recession. The hubris of central bankers. I will not let the US economy go into recession. And he actually tried to engineer a scenario where the US economy wouldn't go into recession. The way he did it was he essentially pumped up the bond market and default spreads. If you look at what happened after 2021, default spreads dropped between 2002, 2000. So people are charging less and less for risk in the bond market while charging actually higher prices for risk in the equity market. It's not just the bond market. People were lending money and charging too low an interest rate. That's basically what it is, right? You know, people give lots of reasons for the 2008 crisis, bad banks, and I'm sure you can name a lot of culprits. To me, the core problem that led to 2008 is not that people were lending money to individuals with bad credit. It's a good business to lend to people with bad credit if you do what? If you charge a high enough interest rate, right? They were lending money to people with bad credit and not charging an interest rate to cover that risk, and that never ends well. So the 2008 crisis, I think, was the first crisis in the last century where the bond market is really more responsible than the stock market, people pushing down spreads too much. In contrast, go to the late 90s. Late 90s, default spreads are staying pretty stable. But equity risk premiums are plummeting. You're in this dot-com boom. People are pushing up stock prices. The equity risk premium is going from 5% to 4% to 3% to 2%. In fact, in 1999, the default spread on a BAA rated bond, the investment grade bond, was 2%. You were getting a fairly safe bond and making a 2% spread. And the equity risk premium for investing in equities collectively was 2%. If you had the benefit of being objective as an investor, very difficult to step back from the fray. In 1999, if I asked you, where would you rather have your money? And I gave you these two options. You know what you should be doing, right? In terms of asset allocation, you should be putting more of your money in bonds because you were getting a 2% spread on the safe bond and pulling it out of stock. And 2007, you'd be doing the exact opposite. Now, one of my problems with the way financial markets are structured is you get a job, you get put into a segment of the market, you get tunnel vision. equity people talk to equity people, fixed income people talk to fixed income people. And sometimes you can have the two markets diverging and they're not even talking to each other. There's a benefit to stepping back and getting that big picture perspective. What's the equity risk premium? What's the default spread? Are they diverging? Why are they diverging? What can I, as an investor, do about the divergence? 2022, they converged. They did the same thing. But keep watching. Who knows what they will do in 2023? So the price of risk in the equity market is the equity risk premium. The price of risk in the bond market is the default spread. What about the real estate market? Do you think there's a risk premium in there? Anybody work in real estate or have a family business associated with real estate? You know what a cap rate is? Anybody want to tell me what a cap rate in real estate is? Cap rate is a capitalization rate. It's a fancy word for, if you give me the rental income on a property, this is the rate that I use to capitalize it. So if you have a 10% cap rate and you have income of $1 million, you'll be willing to pay 10 million for a property because you get $1 million on the 10 million. A cap rate is like a cost of equity that real estate developers demand. And there are services like CBRE reports a cap rate on average over time. And in this graph, the next graph, here's what I've done. I've taken the cap rates from the CBRE database. I've subtracted out the risk-free rate, and essentially the green line is a risk premium on the real estate market. And it tells you a story that I think should change the way real estate is taught and dealt with in investing. When I was taking my classes in investing, you know what I was told? I was told that if you have your money in financial assets, you should buy real estate. Why? Because it moves in different ways than financial assets. Now, I got my MBA in the early 80s. And in the 1980s, that was true. Take a look at what the real estate, it's behaving in, it's a different asset class. Notice that something seems to have happened in the last 20 to 25 years. The risk premium on real estate is starting to look like the risk premium on stocks and the risk premium in bonds. And this is really bad news for all of us. Because you know what it means, right? You own a house. You got $2 million invested in mutual funds. You have a bad year on stocks and you have $1 million in bonds. So you have a bad year on stocks. Is it down 20%? You took the bond market down 15%. Then you look at your house, and you know what you're going to see, right? It's also down 15%. Real estate is no longer operating as an asset class. Why might that be? What did we do to screw up real estate that's made it stop being this different asset class? We celebrated what we did to screw it up, actually. It's probably taught in business schools of this is what we need to do. What did we do? We securitized it. Lou Ranieri, and prior to the 1980s, remember, real estate was a private business. You made a loan, banks made loans. And then came a man called Lou Ranieri. He was a Solomon, brilliant man. And he said, all these billions of dollars of mortgages, nobody's trading them because banks hold them. They sit in their portfolios. What if we bundled them and issued mortgage-backed securities? Amazing innovation. And then wave after wave, more and more of real estate started to get securitized. And one of the things that seems to happen when you securitize something is it starts to behave like a financial asset. It's made our lives more difficult, right? The easy way to diversify is not gone. Just because you bought a house or an apartment and you thought you were safe, that's no longer true. So it'll be good to track these risk premiums by markets, because when somebody says Bitcoin, that's a great investment. It's going to buffer your portfolio. What's the neat thing? You put up I'll wager if you put up equity risk premiums, you're going to get Bitcoin moving like stocks and bonds. In fact, it behaves like very risky stock. And implied equity risk premiums then become the basis for asking the question, is my company under or overvalued? Now, when I walk in investment banks, and most, I don't do this very much anymore, partly because I don't like to dress up. It's, everybody uses historical risk premiums. And the defense they offer is, it doesn't matter, we all use the same number. Let's see if that's enough of a defense. For instance, let's assume that every analyst in your group uses the arithmetic average historical risk premium of 8.17% to come up with cost of equity for companies. In other words, they're doing it because, and it's the same number. Everybody's using the same number. And let's say the implied equity risk premium is 5.94%. January 2023, 5.94%. What are these analysts going to consistently find if they're using an 8.12% premium in the market premiums? Are they going to find most companies to be overvalued or most companies to be undervalued? Think through the math. You've used too high a premium. You're going to end up with too high a discount rate. You end up with too high a discount rate. You're going to come up with a value that's low, and you're going to say, that looks overvalued. That looks overvalued. Do you see where I'm going? Sometimes when you see people say a stock is undervalued, you might want to check out the equity risk premium. They're using a 4% equity risk premium right now. You know why they're finding the stock to be undervalued? It's got nothing to do with the stock. They think the S&P 500 should be 30% higher than it is today. And if they're right on that, why the heck are you valuing the stock, right? Go buy the index and buy index futures. Whenever you use a premium that deviates from the current implied premium, you're bringing a market view into your valuation. What do you think about markets? And that's not a good place to be, right? I want you to value Coca-Cola, not value Coca-Cola and tell me what you think about the S&P 500 at the same time. So let me summarize my case for implied premiums. Rather than backward looking, I'm forward looking. We can debate whether I'm getting the estimates right, but I care about future cash flows, not past cash flows. Rather than sticking with the number, no matter what happens, I am updating the number. It's dynamic. But ultimately, what's a test of a good estimate of the equity risk premium? It's got to be a good estimate of what actually happens in the future, right? So every year I do this manuscript. That's the best way I can describe it, where I take everything I know about equity risk premiums. And I'm going to send you that link as well. It's 143 pages. Use it to fall asleep. It's incredibly boring. But I take everything and I look at historic. And at the end, in the last section, here's what I do. I present you the 6 or 7 different ways. Some people use earnings to price ratios to get implied. It's called the Fed model to get in. I take all these models and ask a simple question. Which of these is the best estimate of returns in the next 5 years, in the next 10 years? Because ultimately, that's what a good equity risk premium should do, right? Be a good predictor. So what do you want when you do this correlation? You want a high positive correlation between what you estimate and what actually gets delivered. So here I have 4 choices. You can use the current implied premium, which right now would be 5.94. People seem to feel more comfortable smoothing things out. Something about smoothing things out makes them feel that this is a more reliable number. So people use averages of my numbers. They take the last 5 years. Think of that as an average implied premium. You could use a historical risk premium, which is what 90% of people do by looking at the last 100 years. And there are some people who actually take the default spread on the BAA rated bond. And over history, the equity risk premium is roughly 2 times that number. This is multiplied by 2. And I look at the correlation between those forecasts and what the actual return is next year, the next 5 years, and the next 10 years. So what do I want? I want a high positive correlation. Let's debate the best positive correlations, but there's one standout here in terms of being a terrible predictor, right? Which is the worst way you can use to estimate future returns? What the heck is wrong with people? They're using an estimate that is almost guaranteed to give them the worst possible answer. It's not that the correlation is low, it's negative. So when historical premiums are high, your expected premiums on stocks are actually lowest. My final argument for implied equity risk premium has nothing to do with theory. It works better than using this backward-looking static number. I used to think about using averages of implied premiums. I said, maybe because you get these months where it jumps around. And the data convinced me not to go that route because it said you're gaining nothing and you're actually losing a little. You don't like to do implied premiums? Go with the default spread times 2. I'll take that over the historical premium every single day. So as you think about equity risk premiums, open the door to this possibility, because you're going to have this argument with people you go work for, because they're going to be trained in historical premiums. They're going to come in with this 300-page book on historical returns. Used to be published by Duff and Phelps. Now it's published by this service called Kroll. It slices and dices historical data and gives you premiums to the 3rd decimal point. And never once is the word standard error ever mentioned in the book, but that's a statistical dropout there. Right? But you'll have to convince people about. I've been trying for 30 years, right? And I'm having some success, but it's a really long grind, because people are so used to doing this. The safest place to be is where everybody else is. But I want you to open the door to at least thinking about implied premiums. I'll give you one other advantage of implied premiums. What was the reason I could not compute a historical risk premium for Vietnam? There's not enough history, right? In fact, that's going to be true for a lot of emerging markets around the world. What do I need for an implied premium? I need a level of the index today, which I should be able to get for any market. I need cash flows last year, which I should be able to get for any market. I just have to add up the numbers. I do need an expected growth rate for the next 5 years. That's tricky for markets like Ghana or Zimbabwe, because there aren't that many analysts making forecasts. So that's tricky, but that's an estimation challenge. But you could potentially compute an implied equity risk premium for every traded market in the world, right? You can forget that. Remember that page I showed you with default spreads multiplied by relative volatility? Skip all of that. Just look implied premiums in India, implied premium in China. I can't wait for that day to arrive, because that'll mean I have premiums that actually reflect what people are demanding in that market. Because right now it's a little artificial, right? I take the US premium, I take the default spread, I do this elaborate dance. I might convince you, I might not convince you. But this way you bypass, what are people paying? So this was actually in 2007, I wanted to compute the implied equity risk premium in the Sensex, the Indian equity index. So I got the level of the index. And in 2007, Indian companies weren't buying back stocks, all dividends. So that's actually a little easier to get the cash flows, because I just added up the dividends. And for the growth rate, I cheated. Most Indian companies, you didn't have 5-year growth rates. But about half of the companies in the Sensex are what are called ADRs, which are listed in the US, or GDRs, which are listed in the UK. And in those stocks, I was able to find 5-year forecasts. I know this is cutting and pasting together. I took that growth rate and plugged it in as my growth rate for the next 5 years. And because my risk-free rate was in this case was 6.76%, I set that as my growth rate beyond year 5. So I'm doing with the Sensex exactly what I did with the S&P 500. Same mechanical process. I solve for R, I get an expected return of 11.18%. So what does that tell me? At the start, in September of 2007, given how Indian stocks were priced, my expected risk premium in India is 11.18 minus 6.76, 4.42%. I'll tell you why I think this might be worth doing. The approach I described last session, where I took the mature market premium and then added the default spread, is built on the presumption that money can be moved across markets, right? So if the premium in India is too low, I take my money out of India and I put it in the US. And in parts of the world where you can invest anywhere. In the US, you can invest your money in German stocks. And if you're in Germany, you can invest your money in US stocks. If you're Canadian, you can invest your money in Indonesian stocks. And if you're Indian, can you invest your money anywhere you want? A little more easily than you were able to do 20 years ago. But it's still really, really, really difficult to do. You see where I'm going, right? You have a market where investors are kind of penned in. Penned in what sense? You have a choice. You want to buy Indian stocks or you want to buy Indian stocks. Say, but Indian stocks are overvalued. Let me ask you again, do you want to buy Indian stocks or you want to buy Indian stocks? Do you see what can happen if you pen in a market? The equity risk premium can actually drop below what it is in the US or what you think is a safer market, and you have no choice. You're stuck with this market. It's not healthy. Because you know what happens, right? You create bubbles inside the market because there's no place to go. But even in a market like India, at some point in time, people say, I'm getting a 3% premium, 2.5% premium. I'm pulling my money out of equities. And guess where they go? They go into real estate. The bubble kind of moves around, goes to equities, and there's real estate crashes. I guess they buy gold. This is a recipe for unhealthy behavior. It's true in India. It's partly true in mainland China. China's been wrestling with how do we open up the conduits for mainland Chinese to invest in Hong Kong stocks. Forget about US stocks. And they open the conduit, bad things. Oh, let me close it up again. When India and China were small economies, this was not a big deal, right? You could do this, nobody cared. But we have the second largest and the fifth largest economy in the world. This is like a powder keg waiting to blow up. Somewhere along the way, you got to ease the process for people to be able to invest outside. It's going to have consequences, right? Initially, you're going to sell off all those overpriced Asian paints. Nice company, but what the heck am I paying 46 times earnings for a company that's getting closer to mature than high growth? Because I have no choice. Maybe we need to revalue Adani with what an Indian equity risk. Right now, I think Indian equity risk premiums, implied premiums, are lower than US premiums because Indian stocks have done so well through 2021 and 2022. They did well much better in 2022 than any other market. If you ask me why are people paying 4,000 rupees per share for that stock, the answer might be because they have no place to go. Okay. So implied premiums allow you to make that judgment. And one final point about equity risk premiums, and we'll shut the door on this topic. I actually, at the start of every year, I have this 47,000 stocks. I break them out and I have to make some judgment calls into developed markets and emerging markets. You're right, I have to make some, Portugal go into developed or emerging markets. And based on this very generic breakdown, I compute the implied cost of equity. So just like I did for the S&P 500 for developed market stocks collectively and for emerging market stocks collectively. You're saying, what are you trying to do? I'm trying to estimate what the market is charging as a premium, and that's what the last column is, for investing in emerging market stocks. So you go back to 2004, collectively emerging, and these are all in dollar terms. So you're comparing apples to oranges, apples to apples. Start of 2004, the differential was 3.27%. Investors were charging 3.27% more for investing in emerging market companies than in developed market companies. You see, that makes sense. I'm not even sure if it makes sense or doesn't make sense, but look at the trend line of that number as you go through time. 2004, 2005, it keeps dropping. 2008 is a little bounce back up. That's a crisis pushing the premium up. But by 2012, investors were pricing emerging market stocks just like they were doing developed. They were charging no risk premium. And the story was, after 2008, there are no developed markets and emerging markets. They're all the same. We don't care. And then in the years after, of course, you get this wake-up call. There's still something emerging about emerging markets that you have to price in. But if you're an asset allocator, you're a portfolio manager saying, where should I put my money? Should I go into emerging markets? This might be a number to track, right? Because you want to go into emerging markets when this differential is wide enough that you feel you're being rewarded for the extra risk. So the implied approach actually gives you a way of reverse engineering what you can make as an expected return and saying, where do I go to get the most bang for my buck, the highest return for the risk I take? And looking across markets geographically, looking across asset classes, you can get a better sense of, hey, these are the classes that deliver the highest returns. Any questions on implied equity risk premiums? So you ready for the Greek alphabet to start? There is no more misunderstood concept in finance than beta. Both people who like it and dislike it seem to have no idea what they're liking or disliking. But you've all seen, right? In every first finance class, you're shown how you get betas. You run a regression of returns in the stock against returns in the market index. The slope of the line is the beta. What a terrible way to think about betas. Because you know already what you've done, you've converted into a statistical number. You run a regression, you get the slope, you get a beta. Just as I dug a hole and buried historical risk premiums, I'm going to dig an even deeper hole and bury this notion that betas come from regression. And there are three arguments I'm going to make against regression betas. So if this upends everything you've been taught in previous finance classes, I don't care. Because it deserves to be upended. First, I'm going to argue that somehow in finance, we seem to forget statistics over and over again. You run a regression in statistics class and you get a slope. What are you required to show in brackets below the slope? Either a t-statistic or a standard error, right? When did we stop doing that? So when you tell me the beta is 1.23, I'm waiting for, hey, what's the standard error? And you never seem to mention it. Second, is it backward looking? How do I run a regression? Returns for the next 5 years against the market? How can I get returns for the next 5 years? I get it for the last 5 years. It's the ultimate backward looking number, right? And if your business mix has changed, God help me, even if I trust the regression, it's giving me a beta for the last 5 years. And I'm going to argue that betas are affected by how much debt you have. Equity becomes riskier for any firm if you borrow more money, and companies' debt to equity ratios change, the beta changes. So let me back up these statements by pulling up traditional regression beta pages. You guys have access to a Bloomberg terminal, right? Somewhere in this floor. Is it? You've never found it? It's there. So keep looking, you'll find it. It's well worth finding because it's in every investment bank, right? It's become this attachment to the world. Without a Bloomberg terminal, you haven't arrived. And it's a neat little device to have on your desk. Because you type in the name of any company and you type in beta, it'll show you the beta page for the company. You no longer have to run it yourself. The regression is run for you. So this is the beta page for a company called GoPro. You know what GoPro did? What did they make? Cameras for hyperactive, oversharing individuals, right? Basically, you know, they put the GoPro on their head and they go on a 3-hour hike and they record the whole damn thing as if you care. They're eating their lunch, 45 minutes, GoProing the whole thing. It's disgusting, actually, to watch somebody eat for 45 minutes. But for a while, it was this glorious success story. We're all going to GoPro. They talked about how they were going to, you know, create entertainment. I always had second thoughts about how can this be entertainment? It's brought down the word. But I decided, so it was in about a year and a half into its, you know, into its public market life, I decided I wanted to see what the beta for GoPro looked like. So I went to Bloomberg, typed in GoPro, typed in beta. There's the beta page. It's like magic. There's a raw beta, 1.604. This is great. I've got my beta, right? Third decimal point. But remember your statistics. Keep going down. Oh, standard error beta, 0.50. Somebody help me out here. I get a regression beta 1.60 with a standard error of 0.50. And I ask you, what's a fair beta for GoPro? What's the range you're going to give me? That's with 67% confidence. You like 67% confidence, I can see. With 95% confidence, you're going to basically go, no. It's actually 95%, plus or minus 2 standard errors. So the true number can be 0.6 to 2.6. How does that even help me? And are you surprised? That's what I mean by noisy. Now, part of you is saying, but what about the adjusted beta? Sounds sophisticated, right? You have visions of 5 people at Bloomberg sitting around a table. Let's adjust the beta. So I'm going to give away the secret as to what exactly the adjustment is. It's 2/3 times the raw beta plus 1/3 times 1. If you don't believe me, print out the betas for 40,000 companies. Try every single one of the companies. It's 2/3 times the raw beta. You're saying what? See, raw beta is 1.5. 2/3 of 1.5 is 1. 1/3 of 1 is 0.33. Or 1.5 will become 1.33. 1.2 will become 1.13. As I go through each of these, look to see if you see a pattern. 1.8 is going to become 1.53. 0.6 is going to become 0.73. So what are they doing to betas? They're getting a raw beta and pushing it towards 1. What's so magical about 1? It's the average beta across. They're trying to be helpful. They think as your company gets bigger, and its beta will probably move to the, which your response is, please stop helping. Because why should these 2/3 and 1/3 weights? They must be magical to work on 47,000 companies, right? So first time I encountered this, I decided to call Bloomberg, not the mayor, but the company. A long time in New York, that was very confusing. When I said Bloomberg, do you call the mayor? No, it's the company. Maybe I should have called the mayor. I called them and I said, look, I want to talk to somebody about your beta page. They put me in touch with the beta calculation guy. There is a guy at Bloomberg whose life it is to maintain this page. Can you imagine how exciting his life must be? He goes to a cocktail party. I'm the beta guy from Bloomberg. Dozens of people gather around for anecdotes, right? Not. The guy's pathetically grateful to get a call from the outside world. I don't know what they do to him. Maybe they keep him locked up in a basement room and feed him through a hole in the wall. He said, I'm so glad you called. I have all day to answer your questions. I didn't have all day to ask him questions, but I was afraid that if I hung up the phone too soon, he might do something rash. So after about a few minutes of polite conversation about how much I like Bloomberg terminals, which I don't, but I had to make it good, I hit him with a question, why 2/3 and 1/3? He said, huh? 2 minutes of silence. I can hear terminals being turned off and on, papers being rustled. Comes back 2 minutes later. I don't know, it was here when I got here. I said, what does that even mean? He said, it was hired 2 years ago. It was already built in. Don't blame me. I'm saying, I'm not trying to blame you. I just want to know where these numbers come from. Here when I got here. You know how often you're going to get that answer to questions you ask at your work about numbers you use every day? Why are we using a 5% equity risk premium for the US? I don't know. Here when I got here. When did he get here? 1981. You've never asked? I don't pick up rocks and look at what's under them. In a long-winded way, I'm saying there's absolutely no information in an adjusted beta. All it's telling you is which direction 1 is. And if you're having trouble with that, what the heck are you doing valuation in the first place, right? If you're at 1.5, you know how you get to 1? You go 1.4, 1.3, 1.2, 1.11, you're there. I don't need somebody holding my hand and say, let me push you closer to 1. You seem a little confused. It's noisy and the adjusted beta doesn't do much. But once in a while, you will get a great looking beta. You're going to start celebrating. The best looking beta page ever. Beta page I printed off for Nokia, like 2001. At that time, Bloomberg actually used to report the adjusted beta. They seem to have removed it from, maybe they want to leave an air of mystery as to what the adjustment is, because that's still the adjustment. That's, look at R squared of 93%, standard error close to 0. This is a statistics class, I'd get a gold medal, right? But before you get too excited, why does Nokia's beta look so good? What does the beta measure? It comes from a regression of returns in the stock against returns on a market index, right? For GoPro, that was the S&P 500. For Nokia, it's the hex. I thought that was a witch's curse until I ran the regression. You know what the hex stands for, right? It's a Helsinki exchange. You're saying, what the heck is Bloomberg going to Helsinki for? Nokia is a Finnish company. Bloomberg is very parochial about the way it estimates betas. You go look up the beta for a Chinese stock, it'll be against the Shenzhen if it's listed in the in the Shanghai exchange, or it can be against if you take a Hong Kong. So whatever stock you pick, they'll pick the local exchange. You see, so what? I'll make a confession. I had no idea what was in the hex. So I decided to take a look, and I wish I had not. Because in 2001, I think Nokia owned Finland. It was like 80% of the index. At which point you got to ask, what the heck is this regression? It's a regression of Nokia against Nokia. And what did we find? An awful lot of the time, the two move together. Congratulations. This is amazing. I never thought this would happen. You run Gazprom, you get the same phenomenon because it dominates the Russian index. And the problem is, once you leave the US, most indices that get used DAX 30 stocks, CAC 30 stocks are narrow indices, which makes their betas completely nonsensical. Because the marginal investor in Nokia in 2001 was Barclays. They bought it for their global index fund. And if you're buying, Nokia for your global index fund, you know how you measure risk, right? You don't measure it against the HEX, you measure it against the MSCI or a global index. If you measure beta right, you will never get a regression like this one. If you measure beta wrong, all bets are off. Which leaves me with the issue, though, and this will be the final point for today, is your beta reflects a slice of history, right? And if something abnormal happens during that period, your beta will show it. Remember, betas, what do betas measure? They measure how you move with the market. They don't measure volatility, they measure correlation. So if something happens that makes your stock either go up no matter what or go down no matter what, guess what it does to your betas? It makes your betas go down. So if I take, for instance, GameStop, and this was at the peak of that craziness, you know what happened to their beta? It went to minus point, let's take the raw beta, minus 0.08. You're saying, what happened? What happened during that craziness? People kept buying stocks no matter what, or selling stocks no matter what. You have nothing to do with the market anymore. And since beta measures how you move with the market, when things happen to a company that are, I'll bet that Adani's beta 2 weeks from now will be lower than it was before they went to the crisis. Completely counterintuitive, but from a statistical standpoint, you can see exactly what's going on. Last page, I told you the last page was the last page, but this is really the last page. You know why analysts love betas? I tell people, look, you give me a Bloomberg terminal, 30 minutes, and tell me what beta you want for your company. I will deliver a printed page with that beta. Try it out. Get on a Bloomberg. You can change the index. You can change the starting point, the ending point, daily, weekly. Which means that what you see as a printed beta page on Bloomberg might just be the 54th iteration that this person tried and said, this is the beta for the company. So when we get back on Monday, we're going to talk about what to do instead, because we've dug the grave for betas. We're going to bury it. And then we say, oh, there must be a different way of thinking about betas. Hi.
You could do arguably anything in finance. What made you like teach finance?
I like teaching more than that. That's my first passion. Finance happens to be what I teach. But if I didn't teach finance, I wouldn't be working in finance. I'd be teaching science. I'd be teaching math. I'd be teaching literature. So my first love is teaching. That's my passion. Finance happens to be a subject I enjoy teaching. But if you ask me to rank, which is the bigger passion? Teaching is my passion. Finance is not a passion, it's an interest.
Okay.
Yeah. What?
Why?
Why do I enjoy
I
teaching?
like that.
Because you got to pick what you came, in life, what gives you the most joy. And to me, the joy comes from teaching. It doesn't come from, I like finance. I enjoy financial puzzles, but my real joy comes from teaching. Everything I do is an extension of that basic concept. You got to decide in your life what you value the most. And you got to find a way to do that while making a living as well, right?
Thank you. Appreciate it. See you.
So I'm just wondering, like, what would be a good range of the implied risk premiums that would indicate like a healthy
What do you mean good?
like is that like people are encouraging to sell, but like you look at the
All you can do is look at history and say, historically, I've earned a 4% premium on average over the last 62 years, and a 5% premium in the last 20 years. I mean, there's no like, this is the market price for risk, right? There can't be a good number. There can be a number that is not out of sync with what people accept over time. So all you can, that's why I have that graph of over time, what does those premium look like relative to the last 20 years, the last 10 years, the last 50 years. But that's all you can do.
yeah. That makes sense. Thank you.
Because
Thank you.
otherwise, there's no theoretical answer, right?
Yeah.
It really is a function of what you settle for.
Thank you.
Hey.
I was wondering, what is kind of a method that you would take to kind of calculate maybe a sector like equity risk premiums,
You
like
can do the same thing with the
Same
S&P
thing.
500, right? I've actually considered adding it. I have so many things to do in the first 5 days of the year that I've thought about it and not done it. But next year I might do by sector level. S&P has 8 sectors. There is indices for the sectors and earnings and cash flows you can download. It's a little messier because unlike the S&P 500, it's already there on the but I have with S&P Capital IQ, you can take all energy stocks, add up their earnings, add up their cash flows. You can do an implied equity risk premium for energy companies, and if you do that, you can skip the beta part, right? Because then you can go directly and add that equity risk to the risk-free rate. You got your cost of equity. So with those people who don't like betas, and I know quite a few people who refuse to use betas, they think, I don't like it. I say, okay. You don't like betas, here's what you need to do. Get an implied cost of equity for energy stocks. And you value an energy company, use that implied cost of equity. There's no CAPM, beta. So if people are caught up in, I don't like modern portfolio theory, I don't like risk and return models, this is a solution, which is it's completely pragmatic. It's agnostic about models, got nothing to do with models. But the numbers are there. And that's the reason I think access to capital IQ is so useful because you do need access to a raw database. You're not going to be able to look it up because you can do shortcuts. Some people use earnings to price ratios. And if you make some assumptions, the earnings to price ratio becomes a proxy for the cost of equity in that sector. But it's messy. It ignores growth. It ignores, lots of things are missing there. So this, and you can take the same spreadsheet I will send you for the S&P 500. Just use it for any sector. It'll work. The spreadsheet itself is malleable enough to be but the collecting of the cash flow data is going to be the part that you have to go to Capital IQ and
do more digging.
it's not even digging. You just have to download it, right? Basically take all energy companies, download net income, dividends, buybacks. They're all on Capital IQ. Aggregate the numbers. That'll give you the collective dividends and buybacks in the last year from those companies. So it's actually not even digging. It's just downloading into a spreadsheet, aggregating the numbers and using those aggregated numbers when you compute the implied expected return.
And I guess kind of a quick little second question. Well, I mean, we are at business school, right? And so, do you think like there's a way that like eventually people are going to become more pragmatic about using different methods, like kind of
No, because the risk averse thing to do is to actually do what everybody else is doing, even if it's wrong. This is not a question of pragmatism, it's survival, right? In fact, it's more risky doing the right thing if it deviates from historic norm, because if you do the wrong thing that everybody else is doing, when things go wrong or things don't work out, you say, look, I just did. I use historical risk premiums. Maybe they were too low, but everybody does it. So unfortunately, the reality of how reward and punishment is meted out is not based on are you doing the right thing, but on are you doing the defensible thing, right? And I think that's why you see I know the way I describe it is bad practices, once they get into valuation, never leave. They become embedded because it becomes safer for you to continue with those bad practices because you can always use the defensive. Everybody uses it. Small cap premium. I don't think there's one anymore, but everybody else uses it. So I'm going to continue to use it.
And do you think that changes with
No,
maybe
it's
every
human
financial
nature,
crisis?
right? I mean, there'll be some people who will change, but they will be people who have actual money at play, right? Because if you're an appraiser, you're an analyst, you have no incentive to change. It's not like you get an upside for being right here.
Yeah.
You just get punished for being wrong. But if you're investing your own money, you might say, look, this is crazy that I'm getting the same premium investing in bonds as I'm investing in stocks. I'm going to start a hedge fund. I'm going to sell short in stocks. And that's exactly what this room is funded by somebody who looked at real estate risk premiums. He might not have used my approach. And he said, this is absurd. I'm going to sell short in real estate. And that was something he had to be creative about. And the money he made is what paid for this, not just this room, but the entire building, right?
Yeah.
So what it does mean is for people who are willing to think out of the box, and usually they're doing it because they're greedy. Let's be quite clear. They're doing it because they want to make money on it. This becomes a way of saying everybody else can do whatever they want. But an investment bank, they have a different set of objectives. They don't make money on being right or wrong. They make money on getting deals. They make money on, But I make money on betting on market mistakes, and this looks like a market mistake to me. So I think that's the niche that, and most hedge funds are just like like investment banks. They follow the herd. They get price. They get But there are some that I think stand out because they're willing to say, look, we're not going to do what everybody else does. And now we have the instruments to trade on mistakes, right? For the longest time, real estate was overvalued. What are you going to do? You couldn't sell short your neighbor's house, right? It's not exactly doable. But we have the instruments now to take advantage of market mistakes. So I think there's a payoff to not thinking in the box. But but if you have a job, that payoff is not on your job. It might show up elsewhere, right?
Yeah, somebody else's bank.
Like computing the sector expected returns. I think it's a great idea. I think companies need to be valued. You try it in a sell-side equity research house or an appraiser, you're going to be shouted down. Because you say, that's not the way we do it. We have a risk-free rate, we have a beta, we have an equity risk premium we got from Kroll and Duff and Phelps. We had a small cap premium, we had a company-specific risk premium, we come with 21%. You're asking us to use 12%. That doesn't sound right. We're going to go with the 21%. So don't expect an easy audience, even if you get the number, but I think it's well worth doing.
Yeah. All right, thank you, Professor.
You're welcome. Take it. Hi.
Yeah, so a question just to clear up some confusion for like valuing small biotechs for the
Yeah.
project. So I noticed like one of these slides you had where it seems like a big part is just estimating the percentage.
Is it a biotech with no revenue, single product working its way through? How late in the pipeline is the product? This is for a
Yeah.
diabetes drug that's not even passed through the first stage.
Yeah.
The further you get towards the end, the more you will have more conventional DCR.
Okay.
So it depends on where they are in the approval process. If they've gone through the third stage of the approval process, it's basically about estimating potential market revenues growth, more like a conventional valuation.
Okay.
If they're in stage one, then you got to estimate now what's the chances that they will be. And you'll have to that will require going and looking at whatever's been written about the drug. This is not a process, whether the first one's going through this. And you can look at the FDA, actually, it's public information. They'll tell you what percentage of drugs working through each stage of the pipeline make it to the next stage. So first check where their drugs are in the pipeline. You might not need a decision tree if they've already made it all the way to the production stage.
Okay.
Now, in which case, it's just a more conventional, forecast the market for the drug, forecast the pricing. I'm not saying any of those are easy to do because when you're talking about
I think it'd be like harder than a normal company. But
it
I
is
thought
harder.
might be
It is
more
harder than a normal company because it requires some medical knowledge, right?
Yeah.
Some knowledge. I mean, you can't value a company that has a drug for cystic fibrosis if you don't know how many Americans have it,
Mhm.
what percentage of those Americans actually
What
can
other
afford the
drugs are on the
drugs,
market.
what other drugs are in the market. So you're right. But it's research. I mean, if I did Coca-Cola, I'd have, but the research when you do cystic fibrosis is not something you're going to be able to read up easily on Google search or make a gut feeling conclusion. It will require delving through. It's in the public domain, but you'll have to read through a journal article on a drug which talks about why this drug is better than the other three drugs. So,
Yeah. I'm also doing a bio major, so I'm hoping
so I
that
think that
helps.
you should be able to. I mean, let's face it. Your competitive edge has to be that you can bring to the sector knowledge that most people who are novices cannot bring in. That you're aware of this process. You can think about a drug being developed. You can think about how drugs get approved and not approved, and so you are working on a competitive event. Doesn't mean that it's going to be easy, but it'll mean that you're building up your that niche. You're connecting your bio knowledge with valuation, and I think that's the payoff you're looking for.
But yeah, so I had two different companies I was looking at. One like actually has a decent amount of like later stage pipeline stuff, and then one it has.
I would go with the first one. The second one is going to be too much. It'll be a single drug. It's less a company and more a drug. Because my guess is many of the companies that look like your second one never make it as going concerns. They get bought out by some large pharma company because that's the way pharma is evolving. Is they let some young company develop a drug, get it all the way through the approval process, But actually taking it from there into commercial development requires a huge amount of investment in salespeople, and many of these young companies don't want to do it. They don't have the resources to do it. So they go to Upjohn and say, "Hey, do you want a cerebral palsy drug?" We worked it through the pipeline and they cash out and they go back to basic R&D so they can work on the next drug. So it becomes, you're with the second company, my fear is you're going to end up pricing or valuing something that's going to end up being a single product rather than a company.
Okay, yeah, that makes sense. And so if they only have like a few years of cash flows, then
Doesn't matter, right? It's to the extent that you're forecasting, the few years can help. But even if you had no years of cash flows, you'd still be forecasting, right?
sounds good. So for the like estimating, if it's like phase 2 or something, you just get like sort of a general market like percent chance. For
Yeah, I wouldn't get to remember, the more of a portfolio you have, the less payoff there is to breaking it down into its individual elements. I would never take a Merck or an Upjohn or a Pfizer and break down its revenues by drug. It's not worth the effort, because you're actually better off forecasting the aggregated number than you are individual numbers. It's one of the strange phenomena in forecasting, is aggregating a bunch of items that you're uncertain about will actually give you a better shot of getting a better estimate than trying to forecast each individual item.
even when there's only like 3 or 4 items, or when
Well,
we're
when
talking about a much
the
bigger
larger the number, the less payout. But if there's only 3 or 4, you can then break out the 3 or 4 and do it. But then remember, it's a company. As long as it's an ongoing company, there's a pipeline. And so the part that you will not
just pay off
catch
on, like
is
R&D.
there will be future drugs that come out of this pipeline, and that's going to be built into your value as well. So at the end of the process, even if you get all 4 drugs they have valued and add them up, it might not be the value of the company, because people might attach a premium to the fact that they have the great R&D department that's worked on these 4 drugs. And remember, when you're successful with a drug, it gives you these little offshoots that you can use to develop, like Moderna, the mRNA. Now is going to create a vaccine and revenues, but the basic technology, they're already thinking about where else can we use it? What other drugs can we put it in? Build on it. So that's what you will miss when you do a drug. So remember, we talked about some of the assets. That's one of the diversions we talked about. You can value companies as sum of its pieces. You're in a sense valuing a drug company as a sum of its pieces, and you're trying to value each piece separately, and that's okay. But there is an invisible piece of continuing research, continuing to throw things out, and you have to bring that in as well.
Okay.
Yeah.
Sounds good.
Great.
So I got a friend who was a semester graduate last winter. He was technical class. He's a big fan of you. He bought a book and wonder if you
Sure. What's his name?
Jason Jiang.
Jason, right? I'll just use his first name. So you said he took my class last year? Or
Yeah, I don't know when exactly.
what's the date today? 8th, right?
Yeah, that is.
Yeah.
Thank you so much.
You're welcome.
Professor, one of my friends' dads actually was in one of your MBA classes
Oh, wow.
in the 1989 class.
A very early class. I was 3 years into my teaching there.
Thank you.
Take care.